So welcome everybody to the market analysis for capital discussions. I'm Tom Nunemaker and Jim Riggio is with me. And before we get started, we have our little disclaimer that you're seeing in front of you, but it basically says that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commission. So with that out of the way, do you want me to give you the ball so you can share your desktop, Jim?
Tom, why don't you just go over to the calendar first?
Oh, all right. I got to reshare my desktop then. 1 second. Let's see the calendar. I can just go here. While that's loading, here's my futures chart. There's the October, November, December futures. So, yeah, they're all kind of in contango, looks like.
And in that, yeah, we'll go back to that one because I'll make a quick comment about that.
Okay. So loading up the calendar. Here we go.
Okay, if you just kind of maximize that so it's a little bit easier for everybody to see. You know, you take a look at what's going on right now, and, you know, one of the things that I kind of wanted to point out in the calendar was how often some of the Fed presidents are going to be speaking. You know, they're the ones who will end up making comments. Dudley's comments today, you know, that was a part of the reason why the markets got a little bit spooked. They know interest rates are coming, but they keep thinking that everybody's going to have enough time to get out of the market before interest rates start to end up moving. And every time any of the Fed presidents even breathes wrong, they get afraid, and the market saying, uh-oh, what happens when interest rates end up moving up? This move up that we've had over the last, you know, actually, you know, 4, 5, 6 years at this point almost, has really come, there's been a recovery without question, but the multiple expansion, the PE expansion has just been extremely large. When you take a look at what's going on around the world, you know, the U.S. economy is somewhat better, but things are really not very good. When you take a look at debt ratios, you know, Japan specifically, things have gotten to be extremely ugly in that area. When you end up taking a look at certain things at growth rates, I don't know if any of you end up reading John Malden. I had mentioned him a couple of times before, but I will tell you that, you know, some of his stuff I really ended up liking. It's a bit long-winded at times, but, you know, when you take a look at example, and, you know, Tom, if you do give me the ball, I'll pull up his email that I ended up having, because there were a couple of graphs in this past weekend's newsletter. And, you know, I just have it up on another system, so I'll just sign on here. And I am going to share desktop. And let's take a look at, I just need to find, get that down, and I need to end up looking up. You know, I'm sorry, the thing is that I'm not on the same computer that my email system was on, so.
Not a problem.
And here, I'd say what, I'm bringing it over here. I'm just searching for Malden. Okay. Here is an interesting graph. This ends up showing where real GDP has been for the Big Seven, okay, or the G7. The U.S. only is trailed behind Canada in terms of where we've come back from since the 2008-2009 lows. when you take a look at a lot of places in Europe, they have not, okay, had anywhere close to the recovery. France and Germany to a lesser extent, but France was doing very, very well when we were seeing all of those Greek bond issues, but they've really slowed up. Japan only recently got back to their 2006 levels, and Britain just did it this quarter. So when you take a look at GDP growth of where countries were, yes, we're on the right track, but you know what? We kind of led everybody up, and the thing that kind of scares me is that we're the ones who start to come down. Now, I know it was weather-related. Okay, people talked about the first quarter and stuff, but still, it's a bit scary. This was another graph that I wanted to end up sharing. And this graph ends up showing what happened in terms of real interest rates. Okay, interest rates minus inflation coming out of different recessions and then the recovery. And you can see that interest rates have continued to end up going down. This is really because of the Keynesian school of thought that Larry Summers and most of the current administration have put into place, where they're saying, well, the private sector isn't pulling their weight, so we're going to be spending more and more and more. The challenge with that is that when you end up taking a look at the number of jobs, and this is a great graph here, and I know it might be a little bit small, and I don't know if I can make it any bigger. But what this ends up showing you is the job loss from every recession that we faced since World War II and getting back those jobs afterwards. Now, this does not end up accounting for population growth. So when you take a look at it, we just recently got back to gaining all of the jobs that we had back in 2007. And the reason why the unemployment rate actually seems somewhat reasonable is because the labor participation rate has just been so low. When you end up taking a look at, okay, and this next graph ends up showing where we are on our business cycle in terms of recoveries year-over-year GDP. And you can end up seeing that after this past recession we had here, this is 2008, we never got above the average, which was 3%. So there are just a lot of things that are troublesome, okay? This graph ends up showing our liability of GDP versus household debt. Our household debt got up to be 100% of our GDP debt.
Oof.
I mean, yes, household. Now, a lot of this line came down because people were foreclosed upon, okay, and their debt on their house went away, but so did their house.
Right.
So I take a look at this, and one of the reasons why, if I come back to last comment about Keynesian, and then I want to end up going back, this graph ends up showing for every dollar that was spent by the government in terms of taking on new debt, what we got for an increase in our GDP. After World War II, for every dollar of debt we took on, we got $4.61 of increase in GDP. In the 50s through 1984, that number dropped to 63 cents. In the late 80s to 2000, every dollar new debt we took on, we got 24 cents of new GDP. Basically, since this century, we've only got 8 cents. 8 cents of increase in GDP. Think about this. For every extra dollar that the government takes on, only 8 cents went into improving, okay, the economy. There are issues. If I go back to, well, why has the U.S. done extremely well and Canada have done extremely well? A lot of that has to do with technology. You take a look at I think in 2016 right now, we're scheduled to become the world's largest oil producer. Why? Because of technology. It's because of, the horizontal drilling and all of the shale production and the fracking. Okay, that has helped enormously. Um, so when you take a look at it, I take a look in a bigger picture. We're kind of in a race between, how much debt do we get crushed under the burden of debt between governments and household debt, or can the technology outgrow the pace that we're taking on debt? Um, and in 2008 was the last time we had any, scare that, uh-oh, we're not going to be able to end up doing this. I think that in the long term, that increase in technology that we end up having and the oil production and the, the shale, the fracking, and also the technology, whether it be biotech, okay, or any of the tech sector, um, does end up growing us. The challenge is that they become less and less good paying jobs, but the good paying jobs are great paying jobs, and I don't know how that separates or how anybody can combat that separation of classes between the haves and the have-nots. It just gets worse and worse and worse, okay, with the technology boom that we end up having. So, in terms of a macro picture, I want to start taking a look at the S&P 500 and do some technical analysis. But from a macro picture, what I end up worrying about is that I think that we have some instability that we're going to have to end up facing over the next short period, 3 months, 6 months, a year, or whatever. But I think longer term things look great. But over the short term, I think that we may have to take some pretty hard medicine. The thing that's always scary is, September and October are our worst months. When I take a look at this, and let's go to some charts here.
You're talking about technology. The jobs aren't necessarily in the U.S. either. Technology allows you to have workers in the Philippines or India or wherever and still working for you, but they're not in the U.S., so it's kind of a different workforce.
It really is. The thing is that people had seen some of this stuff happen. Like for example, I live in South Florida. Burger King is headquartered down here. Okay, Burger King ended up merging with a Canadian company because their tax rate was so much lower. One of the things that we do have to end up seeing, and it's wonderful, and boy, they're great sounds bites. Tax those rich corporations. The problem is that if you do that too hard, they say, fine, we'll take our operations overseas where our costs will be much, much lower. Then you'll only get tax not on our worldwide profits, but only in the little piece that we do in the U.S. or whatever percentage. And so, they have the resources to end up combating any type of tax games that Congress might want to end up playing. And the challenge is that the corporations can afford to spend a lot more money on their lawyers. Okay, because don't forget, they're very, very high-priced lawyers, okay, and very, very high-priced tax consultants to be able to say, how do we end up keeping our tax structures as low as possible? Tom, I used to end up being a partner at PricewaterhouseCoopers, and we were going to take our consulting group where I was a partner, and we were going to end up going public. And IBM bought us right beforehand. But we were going to be incorporated in the Caymans. Okay. Our tax, Anderson Consulting, for example, that's where they're incorporated, because you end up paying your overall global tax bill is so much lower. So they can end up putting those things in, and if you can end up guilting corporations into, oh, that's un-American, okay, they shouldn't be doing this. The challenge is you can say it's un-American, but the directors of a corporation, their first commitment is not to Americans, it's to their shareholders.
Exactly.
So they're going to do what's going to keep their tax base the lowest because that's what's best for their shareholders. And if their shareholders are American, they're going to make more money anyway. And then if
Right.
Americans who make it want to give their money away to the government for them to spend it silly the way they can. But it's a big challenge, and it doesn't go away with sound bites or trying to end up. Yes, you take a company like, for example, Boeing. Okay, this was a great example. Boeing was going to move their facilities for building their new Dreamliners from Washington State to South Carolina. South Carolina is a right-to-work state, which just basically means that unions are allowed to form, but you get to choose whether or not you join or not join. You pay union dues. When you live in a non-work right-to-work state like Washington State, if a union forms in the shop, whether you choose to join the union or not, the union gets to take their dues out of your pay.
Mm.
Okay, so hence, for most states that are right-to-work states, their costs are going to end up being somewhat lower. Do the workers get paid less? On average, it's close, but yes, they do get paid a little bit less. And the government, the Attorney General actually stepped in and tried to, and the ACLU ended up starting it, but they tried to end up suing Boeing so that they wouldn't leave, and the Attorney General ended up actually, Eric Holder, joined the lawsuit. It was dropped, and it kind of was dropped without any fanfare, but you end up thinking about it, it becomes pretty easy. I know if I'm CEO of Boeing and I have responsibility to my shareholders and how much profit I can end up making for my shareholders, I end up writing, Mr. Holder, a very nice and polite letter that just says, you may be able to stop me from moving my operations and my assembly plants from Washington State to South Carolina, but you can't stop me from moving them to China. You choose. And so when I take a look at what's going on, there is somewhat of a challenge. Now, when did we end up getting the dip? I don't know. Let's start taking a look at technicals, okay? Because to me, that this is where the rubber meets the road. What you're taking a look at is this is the 50-day exponential moving average. You can see that we've pierced it a couple of times or challenged it. Every time we've only been underneath it for, a short period of time. Kind of interesting. This was the ugliness that we saw in the beginning of February, end of January, beginning of February, and this was the ugliness that we saw in the beginning of August, end of July, beginning of August. Both of these things only lasted for a week to two, and we were done with it. Are we coming down and challenging it again right now? Yes. Do we end up piercing it, or do we end up touching it and bouncing off like right here, for example? I don't know. Okay, but what I do know is that all of the technicals, okay, the MACD, okay, and here's where I'm having confirmation. The MACDs have started to turn negatives. The stochastics have started to turn negatives. The RSIs have started to turn negatives. And the two quickest ones are normally Williams percent R and CCI, and they're both negative. That's not to say that they can't end up going down and bouncing very quickly, but any type of market pullback always starts like this. So overall, we've seen it. Now, the challenge, by the way, is that the large caps have done much better than the small caps. Okay, this is the Russell. Okay, the Russell, we've broken the 50-day, okay, a long time ago. Okay, we've cracked the 200-day. The Russell tends to end up, being much uglier, okay, when things are bad, and much better when things are good. Take a look at the example for today. The E-minis, right? The S&P futures were down 91, 92 bips, okay, 0.9%, versus 171 basis points for the Russell. This has been happening. Okay, it's been happening on bad days. The Russell has been doing twice as bad as the large cap. And when you end up taking a look at other places, like, for example, if I take a look at EFA, which is the international um, 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 ETF, um, we're looking pretty ugly here. If I take a look at the emerging markets, EEM, okay, this is not a pretty picture, okay. U.S. large cap, okay, and people end up seeing it, it's holding up the best out of any of them. And you saw the reason why it was because you saw the economy graph that I showed you in the John Malden email. There is, some real issues in and around, productivity, our debt, um, the growth of the economy. What's going on, what's going on in Europe right now is that there is a huge amount of QE. They're just starting their QE. We're finishing our quantitative easing. They're just starting theirs. One of the things that I wanted to end up showing you was a debt graph in here. Okay, here's public debt. Okay, what you're looking at here, here's the U.S. in blue. And let me see if, I don't know if there's any way for me to end up making that bigger.
Try doing like a Control Plus on your keyboard.
Oh, here we go.
That could zoom. Yeah, there you go.
Okay, very good. Look at that. It's just what Tom said. I always knew Tom was a smart guy. Okay. Okay, and let me just make that a drop bigger. Okay, hopefully that's a little bit easier to see now.
Yes.
Okay, so what you can see here is you're looking at debt, okay, public government debt as a percentage of their GDP. Okay, now if you remember, this little blip right here in Greece is when they had their bond crisis. At what point do an increase in the percentage of your debt as compared to GDP become a major issue? And the answer is when the market loses confidence. Okay. The challenge with Japan, and it's been ugly for many, many years, is that Japan basically looks like the U.S. with maybe a 20-year head start. The population of Japan is aging compared to many younger countries. If you take a look at the U.S., as baby boomers get older, more and more of the population gets older. That's a huge drag on public spending. Okay, because after all, we can't end up just putting old people out in the street. What do we end up doing? And the problem is that, I mean, that's all well and fine, and I agree with it, but somebody pays for it. Okay, it's not like it's free. Okay, I mean, you can say you want to end up doing it, and what ends up happening is because it's difficult to end up raising taxes and putting an extra burden on everybody, public debt goes up, and it becomes a big issue. So when you end up taking a look at what's been going on, even though Greece is back to the levels where they were, there isn't the same issue. Now, what's happening throughout Europe is that they're just starting to go through their quantitative easing, which means that the ECB, the European Bank, is going to be buying more and more public debt. Somebody explained to me how Spanish rates, when we were down here, okay, on the 10-year, were like at 6, 7, 7.5%. And now they're close to U.S. rates. They're in the 3s. How does their percentage of debt compared to their GDP go up, but yet their interest rates go down? And the answer is it's artificial. It's artificial by, the Federal Reserve banks of the world, all of the bankers, whether it's the ECB, the Bank of Japan, Bank of England, as they go out and they buy more and more of their own bonds, it makes their interest rates go down. Well, if you take a look at Japan, they have to do that because, I mean, otherwise, if interest rates went up, they would be crushed. So almost by definition, the government can't afford for interest rates to end up going up. But if their debt goes up too much, it can end up getting very, very ugly. If you think about the issues we had in 2008, you take a look at where debt was in the U.S. and this huge spike. This huge spike was basically us transferring the debt or any issues that we had in the economy and the Federal Reserve going out and buying massive amounts of assets, U.S. Treasuries and U.S. agency bonds, and putting them on their balance sheet. So basically all we did is that we transferred that debt from the private sector to the public sector. Right? It didn't go away. Okay, it didn't go away. We haven't ended up, the only way you make the debt go away is that there's an increase in productivity, there's an increase in GDP, and then you can end up paying down their debt. This is the reason, okay, why you see, look at what's happened, okay, with Germany versus Spain. Okay, much more productive country, lower employment issues, okay, lower unemployment. Okay, so they're able to end up being in a much better position. And quite frankly, they need to be, because who's going to end up paying for Spain or Italy as they get out of control? If the Germans want to keep the euro, it'll be the Germans. Okay, the French, okay, if you saw in the other graph, okay, have not gotten to be in a better position, while they might have been close to Germany back in 2009 or so. They've gotten worse during that time, while the Germans have gotten stronger.
And the Germans on the street here are not happy about the prospect of paying back everybody else's debt. When you see the retirement age in like Greece is like, 50 or 55, and the Germans are working much longer, the feeling is, why should we pay for your early retirement? So there's a lot of resentment.
There's a huge amount. Now you remember the outburst in this country with the 99%. Why should those bankers make money and we don't? Do you remember the tyrant? What was it? Not Joe Kernan, the other guy on CNBC who speaks in Chicago. Santelli.
I don't watch.
Rick
yeah, I don't watch
Santelli.
CNBC. Yeah.
He went out on this, outburst one day, and it caused this huge amount of issues, saying, why should your neighbor have gotten to buy, that huge house that they couldn't afford, and now you have to bail them out when you didn't do it? And there were a lot of people that ended up doing that. Now, take that and throw a couple of millennium of prejudice between countries. Okay, like, the Northern Europeans and the Southern Europeans, and you guys have been fighting for what, about 2,000 years? Okay.
Oh yeah, I mean, I just drive 10 miles, and there's an old German Zoll, which is the customs office, because the French-German border used to be there. It's like a rubber band over the centuries.
Right. So what ends up happening is, and I've lived there. It's like I've seen it where countries, okay, there are severe and deep-seated resentment, okay, from one pocket to another, and so when you have something like this, people don't end up realizing that basically right now the path that the euro's on, it's a pressure cooker. It really is. And if you have another 5 years of what you've seen over the last 5 years with the Spanish and the Italian debt, okay, and the Greek debt going up and the Germans doing better, it's going to end up being very, very ugly. When we talk about where the euro is, I was talking to one of my colleagues, and he said, well, there are really 2 euros. Instead of the euro being, where do we close today, Tom? We're in the 130 what?
Oh, no, it's 128 something.
128. Okay.
128.50.
instead of it being at 128, okay, you probably have like a 75 cent, okay, southern euro and a $2.25 northern euro, meaning the northern euro is much stronger than the southern euro. And at what point, okay, do things end up happening? You know, you had a little almost like a farce, okay, of what went on in Scotland. What happens if they did end up voting for their independence? Would the European let them back in? Probably not. Could they stand on their own? I mean, there are major, major issues. Everybody forgets about how things were. Anyway, you know, I don't mean to end up going on, but I do mean to end up telling you that when I take a look at it, there are a lot of reasons when I end up seeing emerging markets look this week. When I take a look at international and how we end up looking, okay, over here again. Now this is the EFA, you know, how weak these technicals look. And if people who only look at the S&P 500 and say, oh, it's not so bad, you're being masked a little bit by how strong large cap is in the U.S. compared to all other equity markets in the world. And it's just, to me, it's cause for, you know, potential concern. Are we concerned right now? No, I don't worry too much at all about, you know, matter of fact, you know, our 50 might end up acting like support at, let's call it 1975 on the SPX. Can we end up breaking it? Yeah, of course we can. Longer term, are we, if I end up showing you this in a longer term graph, and let me do it this way. Okay, what you're looking at here, and we always do this, by the way, we take a look at from a monthly perspective. Now each one of those bars is a monthly graph, right? No big deal right now. If I end up showing you, well, what's happened, that's on the SPX. Well, what's happened on the monthly graph going back 10 years with the Russell? Oh, let me just get rid of those spots. Sorry about that. Those are Fibonacci's that leaked over. Okay. Ooh, that kind of looks like topping action to me, doesn't it? I mean, it looks like we're running up. It looks like we're getting ready to roll. Okay. Here, all of the technicals are all negative. If I go and I take a look at international, again, you know, we still haven't reached our peaks back from, you know, 2006, 2007. We're getting rid. Does this look like we're getting, all the technicals are negative. Okay. Same thing with international. I mean, with emerging markets. Yes, we had a little bit of a recovery, but we've kind of been flat here now for, you know, 4 years. You know, and so it seems that it can't get out of its own way. Buyer beware, I guess, is the bottom line on it, Tom.
Yep, absolutely.
So, anyway, so that's the technical perspective. I didn't look at the chat. Do we have any questions?
We had a couple. Let's see.
Death crosses.
Death crosses, yeah, that was fun.
We just love death crosses. Death crosses, for a lot of people who don't end up knowing, a lot of people consider a death cross is when the 50-day crosses the 200-day. So if I end up coming back and I end up taking a look at, you know, here, this is the Russell, here's the 200-day. Now, I have, you know, disclosure here, I'm looking at exponential. Other people look at simple. I have other charts where I end up looking at them in simple. I don't know if I have them handy here, though. You know, so these things are not, okay, matter of fact, when you take a look at, now remember, these are months. Let's go back to the dailies. See, now here's where it's scary, is that the difference between the 200-month, 100-month, 50-month, that growth has been expanding. It's been getting wider. And these things act like a rubber band a lot of times. If you get too far away from your moving averages, you come back. So from a long term, we're pretty far expanded, which means that on the multi-year chart, if we have a pullback, it can get pretty ugly. Now, if I take a look at what that looks like on a daily basis, let me take a look at it on a daily. Okay, we're still over here. Now, this cross is the 20-day and 50. You know, it's kind of interesting, and it's a very good point. We were actually talking about it, myself and another technical analyst. If you take a look going back over the last few years, every time the 20-day exponential moving average has gone down to the 50, we've challenged it. We may have crossed it, but we've bounced off of it every single time. Like even during, let's take a look at some of the ugly periods, right? By the time we challenged it, we were already in a recovery mode. If you take a look at what's happened, okay, back during the summer, in late July, early August, we came down, we challenged it, we may have touched it, but when we were touching it, we were already recovering, okay? We're not at the point where the 20-day exponential has touched the 50-day yet. I will tell you that if the 20-day gets below the 50-day exponential moving average and we're still declining, that will be ugly. That will be very ugly. Of course, the 200 might act as an initial support for it, but it's getting close.
Yeah, watch your downside then, right? George had a question. He said, what's the most important factors for short-term traders? Macro geopolitical factors or price actions?
It is for short-term trade. It's always going to be price action, right?
Right. Yeah.
You know that, but you know the best strategies. And I just got finished doing an evaluation of for a prop shop who was looking at taking on a new prop trader. And the strategies for the short-term traders that I love the most and the ones that I see to be most successful are the ones that are trading with the longer-term trend and then buying the counter trends. Mm-hmm. So when we're in a long-term up movement, okay, the traders that tend to end up, and by the way, when you take a look at this, the guy who I was evaluating was doing this on a 15-minute chart, okay? And what they would end up doing is that when you would end up having pullbacks, they would end up actually buying the pullbacks, and if you're in a down market, what people end up doing is selling the bounces, okay? Right now, until further notice, until the market proves us otherwise, at least the large cap U.S. is definitely in an uptrend, right? So buying the dips, okay, is a very nice trade. The small caps, even though it's not nearly as steep, it's still in a longer term, sideways markets up a little bit. When you take a look at what's going on in Europe, okay, I don't know if you can say that uptrend is still intact. Okay.
Not for a while.
At least, for the last 4 months, we've kind of broken it, and if we continue going down, it does not look that great. And when you end up taking a look at the emerging markets, yes, remember, because on the long term it was very flat. Yes, we've had a reasonable 6 months or so, but this last one has been this pullback. Whenever you have gaps like that, those things always, they look back and usually they're inflection points. Either this is a point where we try to end up coming up. Well, I don't think we go straight down from here. I think we try to come up, we fill that little gap, and if it doesn't work, then it starts another downtrend. So for price action, okay, and the technicals are what's always most important in a short-term trade. I would even say as an options trader, a lot of us are options traders. If you take a look, if you're more of what some people might call a swing trade, you're playing for the next, 2 days to 4 weeks. You're selling iron condors or butterflies. You're really a swing trader. The price action is what's going to end up being very, very important. The only reason why I bring up the macro stuff is that the macro stuff has the ability to change the short term very suddenly. And so I don't want people to be, just naked on one side. Realize that good risk management, okay, is very, very important. So,
Sound advice.
yeah, and Tom is very smart. Thank you, David. I knew that one, though. Okay. um, let's see, is there anything else?
I think that's about it.
Okay. So, if there are no other questions, thank you very much. I hope that the technical analysis, okay, is useful for you. What we end up doing, and if you want, one of the services that I used to end up doing for a hedge fund that I used to end up consulting with is that we actually used to end up going over, okay, the daily, the weekly, and the monthly charts, looking at different time frames, looking at where all of the technicals were. And what we ended up doing is that not only would I look at the technicals, but then I would also look I'd look at the momentum indicators. So next week, if you want, we'll go and we'll take a look at what the momentum indicators look like on the markets.
Sounds great. And this week we've got two things planned. For Wednesday, we're going to have Tony Sizemore on, talking basically managed by the Greeks kind of stuff. And then, Jim, are you still going to do that presentation on Thursday with hedging $1 million portfolio?
Yes, we got a lot of questions when I end up showing showing a couple of ways of how to end up building hedges. And what we end up doing, we being, but by the way, my partners up in New York, they end up having a portion of their business, which I'm not involved in. They build hedges for large money managers, pension plans, family offices, hedge fund managers. And I'll end up showing you, okay, together end up doing it on a lot of the major indexes. What I'll end up showing you is on a VXX trade, how to end up hedging for not only a big market pullback, but the associated spike in volatility that inevitably goes with it.
Sounds great. All right, Jim. Well, thanks very much for your thoughts and for everybody for joining us. I think probably a good time to wrap it up.
Thanks, guys.
All right. Thanks a lot.